All right. Three, two, one, and we're live. Yep, got that one down. How you doing, friends? Ernie here. This is the 0 Days to Expiration podcast. The 0-DTE podcast, episode number 66. 66 episodes. 66 shows with incredible content, at least in my opinion. Today's show, I have entitled it How to 10x Your Account Trading 0DTE. Now, I understand fully that that is a clickbait title. However, or is it? Is it really clickbait? Yeah, it's clickbait. But is it true? Well, I think that you can 10x any account with almost any strategy. I would say that if there were a strategy that has a good chance of 10xing an account, this is definitely it. Now, mileage may vary depending upon the person, the market. Of course, you cannot squeeze blood out of a stone. If the market's not there, you're not going to make any money, no matter what the strategy is. The market will give you something different every day. Sometimes it will give you gobs of opportunity. Other times it will give you smidgens. Sometimes none at all. But if you have a strategy that you can set up that where you can take advantage of this, it's certainly worth looking at. Now, let's say that you have a $3,000 account, which is what I started with in my service, the reference account. The size of your position may be anywhere from $75 to $200. That's anywhere from 1.5% to 2% to as much as 10% of your account size. When you have a position size that's that large versus your equity, you're going to experience a great deal of volatility in your growth equity curve. And that's normal, and it's okay. So long as the strategy is strong, you can get over that and you can endure losses because the gains will be so big, and because they have the kind of character that I've put into it, that you can go after much larger wins and weather the losses because they're so small. So now you have a strategy that is conducive to a small account, withstand some of the growth volatility until you can leapfrog over it and get to a slightly larger size, let's say in the $5,000 to $7,000 range. Now you have, instead of say 5 to 10% risk per trade, now you're working on 1 to 3% of your account size. That's a lot easier, where you can reduce the overall volatility of your account growth. Your drawdown as a percent of your net profit, or your net profit as a percent of your drawdown, becomes larger. In other words, your net profit is larger compared to your average drawdown. That means that your growth curve has ever-shrinking volatility, and now it's a smoother and smoother growth curve the more money you have in your account, and the smaller your position size is relative to your account. Now, what I've managed to do since I started the service in April, starting with a $3,000 account, is bring it up to almost $9,000. Hasn't quite got there yet, so that's why I tell people about a 3x gain here. But now I'm almost at that point. Now, by the way, I'm trading this with a larger account. This is my reference account too. So I have the small account, which is my reference account for purposes of the service, and then I have my larger account so I can test out the strategies of what it's like to trade with, say, a 25, 50, 100,000, $500,000 account. But for the purpose of the services, this is what I show inside the service so that people can see how it's done. As you grow that account to something above $5,000, now you're starting to have a position size relative to your account size that is much more tenable. Once you get to about $10,000, that's the point where you can now increase the number of positions that you have, or what we call tranches. And now you can employ different types of strategies for your entries and exits. You can use multiple positions now to either put in a smaller position or put in a second position to reduce your cost basis and give yourself an even better attitude towards the current trade. So as you're getting bigger and bigger in terms of account size, your capability is increasing and increasing. And your volatility in your equity curve is getting more and more reduced, more refined. And of course, along with that, building your experience and your execution acumen, it also helps, of course. That's the growth path that you're on. So I'm saying that with a $3,000 account, you can very easily, and what I've shown is over a course of about 9 months, bring that up to about 3x. I project that based on my other accounts going, that I can, within another year, at least 2x that. So now we're up to 6x, maybe get up to 10x. So within the first year and a half, 2 years, yes, you could 10x your account. I truly believe that that is very possible. Can anyone do that? The answer is yes, anyone can do it if they apply themselves and learn the strategy, develop the discipline, and it's a discretionary strategy, so also develop those skills. Absolutely possible. If you're starting out with a larger account, you have a big leg up because you can already start with multiple tranches in your position size and employ more sophisticated entry and exit strategies and not have to endure a lot of that equity growth curve volatility that you would naturally have when your account is limiting, right? So once you get up in the $10,000 to $20,000 range, your prospects and the number of positions that you can put on change the game dramatically, change the strategy, make it more sophisticated, more smooth. And all of this is because the strategy itself promotes good trading practices because you're trading small, your risks are small, you never feel that anxiety, so you make good trading decisions. You never put to the test, so to speak. A little bit when you're in the small account category, but once you get up to 7 to 10,000, it becomes less of a issue. Anything above that, it's almost a non-issue, where position size and risk that you're taking is virtually non-existent. And so because of that, we like to say that we do not manage our risk, we manage our profits. Because we're able to, through the type of strategies that we put on, take on so little risk for such huge potential profit. And to give you some idea, we average around 150 to 200% return on our risk about 68% of the time. 20% of the time, 15 to 20% of the time, we do much better than that. A smaller percentage of the time, we do what we call a pin trade, where we can make as much as 1,000 or 1,500% on our risk. So this is how you grow an account. You grow it in opportunity leaps and bounds. You do not grow it in this sort of income-laden, dollar cost averaging type of account growth. It is opportunistic. You get a leap, and then you get maybe a small few steps, maybe a couple steps back, another leap, a couple steps. And over time, you start developing a bottom left, top right type of strategy or account growth with ever decreasing volatility. That is exactly what happens in this particular strategy. Now, as I said, if you started out with, say, a $25,000 account, it's so much easier. However, I don't believe when you start with an account that size, you don't go through some of the growing pains in understanding what risk is all about. One of the most difficult parts of this strategy is deprogramming people with the old way of doing trading, taking on options trades that have more risk than potential reward, and suffering from that gamma risk when they get close to expiration, and having to do unnatural things like in most other zero DTE services, they literally have to put stops into their trade to protect themselves from a max loss, which could literally wipe out a month worth of gains or more. Something like that never happens in this strategy. It can't happen if you follow the tenets of the strategy, obviously. So that is how you go from a small account to a very large account. And I'm proving it. And the course or the trajectory that I'm on, there is no doubt that I'm going to get to a 10x of my original starting capital for this reference account, in my estimation, probably in about a year and a half to a year and 3/4 from the inception. Right now, I'm about 9 months in, so that's the projection that I'm making. But based on the account growth and also the experience that I have in trading it with a larger account, I think that's exactly where I'll be. In a larger account, you can trade a larger account with virtually no risk and easily produce a 30 to 40% return on your capital. Now, can you do that in a $10 million account as easily as you can with, say, a $100,000 account? I don't have that experience yet, so I don't know. I would imagine that there are slightly different problems that you're going to have to deal with, but I can certainly see this scaling up to about $1 million or more. Then you're now competing with, well, what are the strategies that you use when you're putting a position on that is, 30, 40, 50, or 100 contracts, as opposed to putting on one that is 2 or 3 contracts. Very different dynamic. So, hey, we'll get there and we'll learn those things. So we have a lot of questions. Wow. Can I do a video on how to decide between a butterfly and a broken fly? Well, generally you use a broken fly so that you can adjust the risk. By the way, we use butterflies, out of the money butterflies, to create our risk to reward profiles. We use volume profile to develop our market structure analysis, and then use the butterflies to model our idea based on that market structure. But if you're going to choose, now we use many different forms of the butterfly, either symmetrical, broken, or unbalanced, all 3 different types. And the reason why we might not use a symmetrical is or use a broken fly or an unbalanced fly, is so that we can adjust our risk, our near-term risk, or near side risk for the current market, to make it easier to get into the trade, to improve our risk to reward profile. So that's how you decide whether you're going to use a symmetrical butterfly if you can't get the kind of risk to reward that we want. Now, again, giving you another perspective on what we do as opposed to what everybody else is doing. Most other services are trying for a 9-to-1 risk to reward, or even worse. In other words, 9 parts risk to 1 part reward. And that 1 part reward, they're going for half of that. That's what they would consider their ideal situation. We're going for the exact opposite, a 1-to-9 or even greater, as much as 1-to-20 risk to reward. And we can adjust that risk by using things like these asymmetric butterflies, or using broken wing flies or unbalanced flies, moving them further out of the money based on the amount of volatility that we have, etc. That's how we achieve those types of risk to reward. And here's the cool part. Most people think that the butterfly is a market neutral strategy. And I'm saying that it is probably one of the worst market neutral strategies. It is a far more effective directional strategy, or a near directional strategy. When you're near the butterfly, you can make money, derive income or derive profit from it without ever entering the profit tent of the butterfly. And that's what we do regularly. If you do enter it, then you're making a lot more money. The key is, how do you get yourself into position so that you can be there while your theta is decaying, and while time is moving on, and while volatility is increasing or decreasing. So Sam's asking, how frequently do you place a trade on average per week? Well, we do Monday, Wednesday, and Friday is when there's a 0 DTE expiration. So at least 3 times a week. Sometimes multiple times in a day, but rarely. Usually just 1 trade per day. And Sam's saying, or asking, it's been a while since you started your 0 DTE service. Is the average of 70 to 80% win still relevant? So during periods of higher volatility, we win about 80 to 95% of our trades. But the win rate is irrelevant. It really comes down to the amount of your return on your investment, your return on capital. And that's what's important. We average about 150 to 200% return on the capital that we use. So that's the important part. And then when there's a higher degree of volatility, if it's in our what we call our Goldilocks zone, then we tend to make a higher degree of return on our capital. Sometimes we can pin trades where we're getting 800 to 1,000% return as much as 30% of the time. When volatility is very low, then our win rate and the return on capital decrease. Like I said, this strategy is opportunistic based on what the market's going to give you. You cannot, as I said before, squeeze the same amount of blood out of a stone when the stone isn't a stone. It's a undulating mass. Waro. I don't know if I'm pronouncing the name correctly. Hi, Ernie. How long have you been using the 0 DTE strategy? I think I answered that. I've been using 0 DTE when weeklies first came out, so it's been almost 2 decades. Or a decade and a half, I guess. Simon, what percentage of trades do you hold all the way to the last minute before expiration versus bailing out early? I would say that half of the trades we get out before the market even opens, or in the early morning hours of the market. And the other half we tend to hold on until just after noontime. Very rarely do we hold it right to the very end of the day unless there's that opportunity to pin a trade and go after one of these huge wins like an 800 or 1,000% win. Is there any limit on maximum contracts one can use with ES or SPX? No, there's no limit. I mean, as big as you can trade. It really comes down to your ability to handle that many contracts and what strategy you're going to use for scaling in and scaling out. That will take a fair amount of skill, and I would imagine you'd want to start small and then build up to that point. And I am developing strategies around that while I'm trading in my larger account. So if you have a larger account, I can help you out with that. JP Swede, what do you do on Tuesdays, Thursdays in the market? We rest. We don't do anything. We talk in the group. We might talk about issues, problems, society, memes, whatever. We try to take our mind off of trading, for the most part. And it provides a natural cadence so that we trade, we rest. We trade, we rest. We trade, then the weekend comes, we rest. Kevin asks, can this type of strategy lose its edge if so many people start using it, assuming you get to Tim Sykes' level of fame? That's something that I would never wish upon anybody, to tell you the truth, just that genre. But no, the S&P is so big, we would have to have, I don't know, 20, 50,000 members to make a real impact on the market. Right now, we're just under 500 people. So if we get to 1,000, it's going to be out of this world. It's already out of this world. If I get to 2,000, it's going to be nirvana. If I ever get to 20,000, that'd be crazy. I'd have to hire a whole team. So I don't think it's a problem at all. All right, here's more questions. Will you keep trading also through the Christmas, New Year holiday period? Oh, yeah. As long as there's a 0 DTE day, we will trade it. Sun Microsystems, you must be old. Yeah, I am old. I was chief architect for Sun Microsystems in the late 90s, early 2000s. Kevin Hush, do you supplement 0 DTE with any other strategies or recommend diversification of strategies? No. As a matter of fact, well, that's not true. I do have an investment service where we invest in natural resource companies and other such concerns and mergers and acquisitions. But my diversification is mostly in hard assets like real estate, antiquities, rare coins, bullion, real estate, other businesses, that sort of thing. When I stick to trading, it's trading longer term, trading the natural resources through my advisory service, or short-term trading with the 0DTE. I do not believe in this huge diversification of strategies. Let's see here. Can you trade this strategy with weekly options on stocks, or would that fall into the same pattern day trader rule? It would fall into the pattern day trader rule. And there's no reason why you can't do it. The problem is then you have to really be following each individual stock. I suppose you could concentrate on one, like one of the FANG stocks, because they're so big, they're almost like trading an index. I see no reason to bring this out to stocks. It doesn't make a whole lot of sense. You could do it. There's no doubt. The principles still apply. PDT also not applicable on non-Americans as well. I didn't know that. And One Worm Army. Ernie, with an account over 50K, how would you implement this strategy differently other than just adding larger size orders? And the way you implement this, it's really no different, except that your position size obviously is bigger. So you're able to put on more contracts. So you would pick a percentage of your account to be your max position size. Let's say it's 2% and it's a $50,000 account. So now you're talking about $1,000 risk that you would take. That would allow you to put on about 10 positions here, or 10 tranches. I wouldn't start a trade or a position with all 10 tranches. I would start it with maybe a third of that or a fifth of that. And then as the trade developed, if there was an opportunity to add another tranche to reduce my cost basis, then I would. My goal wouldn't be to get all 10 positions in there. My goal is to get the best possible risk to reward scenario that I can. And so that's how I would do it. All right. That's all the questions. Thank you very much for that. Really appreciate it. Let's see. We're 40 minutes in. I think we can end it here. So hopefully I answered your questions. I didn't really mean this. Well, I did mean it to be clickbait, but at least now you understand that there is very real opportunity here to take a small account and 10x it. There is excellent opportunity to take a larger account and make very easy, excellent returns with very, very little risk. Swede asks, can one assume trading NQ or YM will deliver the same return? Now, NQ and the NDX also have 3 expirations per week. I don't believe the Dow does, or the YM. That's what the Dow futures are. Neil asks, hi Ernie, did you ever live trade to show your subscribers trading in real time? Well, we do that every day. We literally do that every day, live trade. I set up the trades. I have my users stage various potential trades. We analyze them, and then when it comes time to put the trade on, I issue the alert, and then people will take the trade. A lot of members have developed their own strategies or variations on what we do, and they may do something slightly different, but essentially the same process. So yes, we do live trading every day. Now, are you asking, do I get on a video and do that? No, that's ridiculous, because you don't know when you're going to actually do this and how long you're going to be in it, and it's just crazy to do something like that. All right. That's it. Except there's another question from Lance. How do you manage profits on a Batman trade? Batman trade are 2 bookended butterflies. They look like 2 ears of a bat. And how do you manage profits? No different than managing the profits on any other trade. If price falls within the area of one of the butterflies and you've had enough theta decay, you take your profits in the same way that we do, using the same strategies that we do with other trades. We don't like to do the Batman trade that often because you're expending additional capital that may end up in a loss, and you could end up actually with 2 losses on 2 trades. So we have 3 trades a week, so we're not so hungry for profit that we think we have to grab every single opportunity. The Batman trade is a special opportunity, like yesterday, when the market just goes haywire one direction and then haywire in the other direction. Marissa Monger asks, when you make a suggested trade, can I assume you are recommending it as a low account value trade or at the middle range? No. So there are 2 different types of trades in our service. We have the alerted trades and the suggested trades. The only way that they differ is that alerted trades, the market was initiated from an economic report or some other market event that happened early in the morning. The suggested trades are trades that happen in the absence of any specific catalyst, more developed from whatever the market machinations are at that moment. So that's really the difference. They're both official trades, and they both happen. I just segregate them and put one in one channel and one in the other channel. So they don't suggest that one is low value versus another one. Like suggested trades aren't lower value than alerted trades. As a matter of fact, some of the suggested trades have been some of our best trades. Okay? All right. Great. Again, if you want to try out the service, I give a 4-week trial. That's ample time for you to get acclimated and understand the service and potentially make enough money to pay for a whole year of the service, at least. And you get to that by going to 0-dte.com/try. The link is down below. We also have a Discord link. You can join our Discord and participate in the public portion of the Discord and talk with a lot of the traders if you want to ask them their opinion of the service. Or you can go to the testimonials section on the 0-dte.com website and read some of the testimonials. So there you go. Or just keep on listening to this podcast. All right. That's all I've got to say. Peace to everybody. Take care. We'll see you tomorrow. The button's right in view. There it is. Turn off the stream.